Welcome to the Zoom live stream of the week. I got Mike to my left here. Tyler, you still
Recording
there?
in progress.
Tyler just started hitting record. Tyler's my
I'm still
moderator.
here.
There
Yep.
we go. I like it. And then I got a special guest for us. Our first, we always have special guests, but this is probably our most famous guest, I would say. We'll see. We'll see. It's only like our first episode, so don't get too excited. Chris Larsen, how are you, Chris?
I'm doing great. Thanks for having me, gentlemen.
No problem. No problem. My camera guys are getting this technical work going here. It's his first
Yeah,
time.
I'm getting dizzy over here.
I'm done. I'm throwing up in a second. But this is our live stream, so we have a group of agents who are watching. We're probably going to get about 70 agents on the Zoom call. YouTube, we're live as well. And then just backstory real quick. Mike runs a team here in San Diego. He's a real estate agent. Tyler runs a team out in Austin, Waco, Texas, I should say. And then I do everything here with both of them. So I flip homes and do all that good stuff and wholesale, and I have a mortgage company and all that real estate jazz.
Awesome.
But we want to get to know you. This is about you and then how we can provide value to our realtors, our investors who are on the live stream now. But I don't know if you researched me. You probably didn't, but my Instagram is Don't Buy Real Estate. And it's kind of like a funny play on real estate, on the pains and sufferings that we kind of go through on a daily basis. So our first question to most of our guests is, what's the worst thing that's ever happened to you in real estate?
Oh man. So this is so I got my I bought my first property when I was 21. I got my real estate license maybe a year or so later. So I've had a lot of ups and downs in real estate. I'm trying to think of the worst thing.
It's tough.
Oh, geez. Yeah, it is. I'm thinking of like what's appropriate, what's not appropriate.
No, you can say whatever you want. Yeah, go deep.
So I, you know, it depends on how you look at it. So there's the active real estate issues. There's working with partners. There's we're selling a piece of land right now, a development deal where it took us 3 months to explain to the state of North Carolina that we didn't have a stream running through our property. And then they said, okay, we see it, and it'll take you 3 months because we have 2 people in the entire state to review and process this. I have stories from renting real estate where I was on my honeymoon in Costa Rica and having to deal with tenant issues. The list goes on and on. But I think the worst thing is that I had a partner that I was in business with, and we syndicated our first deal almost 10 years ago, and that relationship fell apart. So this isn't like the sexiest, craziest story, but I think it's the most important because when you buy real estate, it's typically a long-term play. It's not like the stock market. You don't buy it, you sell it. You're like, I don't like this stock. I'm going to get out of it 5 minutes later. You buy a deal, you're in it. You've got renters, you've got a mortgage, you potentially have investors, depending on how big the deal is. If you're in a property, if you're running a business with a partner that's not vetted, that you don't know, that has issues, that can be not just a deal breaker. That can be like being in a bad marriage where you have kids and property and everything. So that partnership went bad after a few years, and I knew this guy for 20 years. So this wasn't like I just met the guy. And what I didn't do was trust my gut. And I overrode it with, I was like, oh no, this makes sense like on paper. But the bottom line is that if you're going into a deal, maybe you're nervous, but if your gut tells you like don't do this, like this isn't right, something's not right, then walk away from it. The deal of a century comes along once a year, guys. So guys and gals, so don't feel like you're going to have, you may have FOMO, but don't feel like you have to do something if it's not a great fit for you. You're going to be nervous if it's a big deal, if it's your first deal, if it's, you're putting a lot of money on the line, that's okay. But if it feels bad, then you need to step back and say, wait a minute, maybe there's a reason for this.
Yeah. No, I completely agree. And I guess the the flip side of that whole thing is that most people need partners to operate their first
Yeah.
deal, right? Like it's not like
Yeah.
my first deal was easy peasy where I had $200,000 to flip and do this and that. But well, I mean, what do you recommend? They have to go in with
Yeah.
someone on their first deal.
Yeah. Yeah. So, okay. So great example. And I'm sorry, like you guys are bouncing around all over the
I know.
place. So, who asked, who asked that question?
Jason,
Um,
that was me, Josh. Yeah, Josh. Sorry.
Thanks, Josh.
Yeah.
Yeah, no problem, Josh. So, yeah, so yes, so if you're going in with somebody on your first deal, there's different ways you can set it up. So my mom co-signed on my first deal. I
Oh,
can trust
nice.
my mom, right? I can trust. I was 21, so you can trust that person. You can structure a deal so that you can separate it. It's kind of like we were talking. I use the marriage analogy, right? Marriage analogy. Um, I've been with my wife for 24 years. We've got two kids. We've got a lot of stuff. If you're going into a big situation, it's kind of like a prenup. Agree on things ahead of time. Split things so you can get out of it if you have to. But just think about what's going to happen if something goes bad. So I spent 18 years. I bought my first deal at 21. I continued to buy real estate. If you're in your early 20s, you run out of capital at some point, right? So how do you generate more capital to invest? I got a high paying job. I went to a high paying career. I was in the medical device space and I made a lot of money. I invested a lot of money. And a lot of times, the surgeons that I worked with, because I was in surgeries, I was selling implants, they would say, "Hey, Chris, this is a cool product. What happens if the surgery doesn't work out? What happens if I have to take it out?" So ask yourself that question. What happens if I need to get out of this deal? How can I exit this deal? How can we do it smoothly, cleanly, and not blow up the relationship, the partnership? And just think about that. It's always better to have that conversation on the front end than trust and say, "Oh, that's not going to happen. Everything's great. Yeah, I met her at the club and she's got 18 tattoos, but I'm sure, everything's cool and her family's amazing. There's no chance we're going to get divorced, but just, take those precautionary steps."
Yeah, that's funny. In terms of you said medical device. This is Josh again, but medical
Yeah.
devices. So you weren't a full time real estate guy when you first started. Like, walk us through. I know you were a
Yeah.
cyclist. That's as far as I
Yeah.
got on the Google page. I was just amazed at that. I'm like, man, I got so many questions. But like, you were a like, did you win? Like, were you actually good at cycling?
Was that? I love it. You're like, did you just ride around like
Like,
on a
yeah,
paper on your
you
paper
have to
route,
be
or did you
good, right?
actually?
Yeah.
Yeah, that's right. So I started racing when I was 14 years old. Thank you. I never thought I was that great because I was always riding and racing with people that were better than me. I got to train with Lance Armstrong before he won the tour. So
Nice.
that's like I was good enough to train with Lance. I wasn't good enough to race against Lance. So
Yeah,
that's
yeah.
probably how to put it. But I won state championships. I've been All American. I've been top 5 in the nation, top 10 in the world. But I was a good cyclist. I wasn't a great cyclist. And I actually say, because I raced in the 90s, early 2000s, I say I was lucky that I wasn't good enough to have to do drugs, because
Yeah, yeah.
if you were really good at that point and you wanted to go pro, you know, those drugs made you 10% faster. So it was a really tough choice for those cyclists that had the opportunity to really hit the top level. And I knew I would never get there. So I got everything out of the sport, but I wasn't faced with those tough choices. But going back, so I bought that first property at 21. And by the way, guys, if you want my story, you can get a free copy of my book, nextlevelincome.com. If you go there, um, you should have a pop up. You can go to the book link, put in your address, and my team will send you a copy if you're on here tonight. It'll tell you everything. 21, bought the first property. I always considered myself an investor, Josh. And again, what do you do if you don't have money? You have to go create capital somewhere. So the formula that we talk about at Next Level Income is make money, keep money, and grow your money. So have a high income profession or business. That could be a real estate business where you generate capital. Learn how to maximize the money you keep through effective legal and tax strategies, and then learn how to be an investor and grow your money. And if you do that strategy, if you're consistently growing your business and your income and your career, and you're keeping as much money as possible and you invest that money intelligently in areas that consistently grow your money, then that is a sustainable path towards growth.
Crazy. Good. No, that's amazing. Yeah. And in terms of your portfolio itself, I read that 6 billion, 1.8 billion. How do you get all? I mean,
Yeah.
that's a combination of
Yeah.
residential, commercial. Like, I want these guys to start building like their
Yes.
stepping stones in life. So how did you get there from cyclist to sales to real estate, owning all this, like all these assets? That's just amazing to me.
Yeah. So real quick. So, if you talk about the spectrum I'm talking to here, what's kind of our general audience here, Josh?
I would say 50% are real estate agents. The other half
Okay.
are dabbling in the real estate with investing, fix and flips, wholesale, just getting
Okay. Great.
licensed or wanting to get
Yeah.
licensed on the lending side. But they all have the same common goal of either
Yep.
wanting to get their foot in the door on the investment
Yeah.
side, or just being in real estate,
Yeah.
having the education to kind of expand their
Yeah.
careers.
Yeah, so to this point, we've that 2 billion it's actually about 2 billion now. It's leveraged across what are we, like 60 deals, and that's about 120 million of capital that myself, my partners, and investors have brought in addition to other investors to acquire that 2 billion. So my first deal that I bought, that first property, was $3,000. Okay. The first deal we syndicated, and that was in 1999. Okay, so $3,000. That's what I brought to that deal. Okay, $90,000 townhouse at a 7% interest rate mortgage. So 7%, not unreasonable. The first deal we syndicated in 2016 was a 100-door apartment deal in Georgia, and it was about $10 million. And I raised less than $1 million of investor capital. My partner brought some investor capital as well. So, you look at that and you say, okay, 3,000, you scale up, over the course of, 17 years, and then you're at the point where you can invest, say, $1 million, whether it's your own capital or in capital along with your partners, and then you go from there. And we bought deals that are north of $100 million with with our along with our investors. So, $90,000 deal to $100 million deal. Well, it sounds crazy, but when you look at it, real estate is a get rich slow game. So the point is, you need to build a system, and it's just like investing. It's just like Warren Buffett says. You start off and you build that system, and you have $1, you have $100, you have $1,000, $10,000, $100,000. But if that money continues to grow, then those deals are going to continue to scale. So if you're on this call and I see some young faces out there and you're in your early 20s, then you have time is on your side. I'm 46. I'm going to be 47 this year. If you continue to double your money, increase 50%, 20%, then that's going to naturally go up. Put it into your financial calculator. If you invested 20% a year, what that $3,000 becomes. Those numbers go exponential very quickly when you get 10 and 20 years out. But the point is, you want to have a system that works year in, year out. I've been through 07, 08, 09, 2010. We didn't lose any properties during that period of time. I went through the up cycles in the stock market in the 90s and the crash in the late 90s and the early 2000s. We've been through the interest rate shocks that we've had here. You want to have a strategy that you can rely on in up markets and down markets as well. So that's very important. When you're on that ride, just like if there's any athletes out there, sometimes you have a bad game. You don't quit because you lost a game, right? You don't quit the investing game because a deal isn't performing exactly like you thought. But you also want to be careful of being speculative. So if you put all your money in one deal and you're like, well, this deal has to work out. A great book is, or a great series of books, are by Nassim Taleb. And Nassim Taleb talks about how not to blow up. The book that I would read of his, he's got several, is Anti-Fragile. So how do you become anti-fragile? How do you build a portfolio, build a career, build a business that's going to withstand those shocks, right? That doesn't mean you're not going to have ups and downs, but is your business, is your portfolio built so that, yeah, thank you for Mr. Market. How do you build a business? How do you build a portfolio? How do you have investments that, your portfolio is not going to blow up? The point is, just like as an athlete, you might lose a game, but are you resilient? Do you live to play another day? And that's your goal. So whenever you're looking at an investment or an opportunity that's out there, you should look in the mirror and ask yourself, if this goes bad, kind of going back to that partnership example, if this goes bad, am I going to lose everything? If the answer is yes, you better be really, really sure about that. And let me explain another philosophy that I have. This is something that I think the world gets backwards. We say, when you're young, take all the risk in the world, take a bunch of risk, go crazy, go to Vegas, bet all your money on black. Well, my philosophy was, don't do that. Choose a philosophy, choose an investment style where if you're 20 years old, you can be financially independent by 30, 35, 40. Let me ask you a question. Everybody on here, stop for a second. Look at me in the screen. All right. If you know for a fact that in 10 to 15 years, somewhere in that range, you can be financially independent. If you're 25 years old, you say, okay, in 15 years, I can be financially independent. You're 40 years old, right? How much risk can you take once you're 40 if you don't have to make any more money? How much risk can you take? A lot or none?
A lot.
Take as much as you want, right? You are now playing with the house money. Does that make sense? So if you bet and bet and bet and you lose and you lose and you lose, now you're 35 or 40 years old. So I work with a lot of surgeons. They're 35. They come out. They've done their residency. They're now $200,000-$300,000 in debt. They have to make money. They can't take a lot of risk at 35 years old. I was literally the same age as these surgeons that I was working with, and I didn't have to ever work another day in my life. And they had to work for 5, 10, 15, 20 years to pay off their debt. Who could take more risk, right? So build a strategy that's dependable, that's reliable, take reasonable risk that's going to give you a high predicted outcome. And then when you don't have to worry about risk anymore, then you can bet a bunch. And that's what Nassim Taleb talks about. He says, put 90% of your money in safe bets and then bet a ton on asymmetric risk with the other 10%. And that strategy is going to outperform the strategy where you bet early in high risk bets.
That's a good strategy. I haven't heard it put that way before.
And then with real estate, I mean, you have stocks, you have bonds, you have is there you said get the strategy, but what is the strategy? I mean, is there an easy answer to that? I mean, these, I would say everyone on here is under 40 right now.
Yeah.
And so they dabble into the stock market a lot, and that's kind of their entry drug into investing. But that fluctuates every day, like you said. What is there a perfect formula for these guys, or is that kind of what you teach? Is to take someone, sit them down, and say, "Hey, here's what your risk tolerance should be." But what's a quick formula for these guys on the call?
Yeah, so you want to look at what the ultra rich do, right? So you can say, well, hey, how do you make your money? The problem is if you look and you measure and you say, oh, we basically celebrate risk because we like to see winners, right? It's like, oh, you throw the Hail Mary. How many people here have seen the movie Moneyball or read the book Moneyball?
Yep.
Anyone?
Yeah.
If you haven't read it, go read it. Because Moneyball talks about this exact strategy. You want to bet on a strategy that is going to produce predictable returns. I also talk about it in my book. This is something a lot of people don't understand, which is variance drag. So when you have investments that fluctuate like the stock market very wildly, if the stock market loses, if the stock market loses a third of its value, how much do you have to make the next year to get back to even? Anybody? Put in the chat. Stock market loses a third of its value. What do you have to make the next year to get back to even? Yeah, 50%. Okay. How many years does the stock market return 50% in 1 year on the upside?
No.
Okay. But has it lost 20, 30, 40% multiple years, like over history on the downside? Answer is yes, right? So that is a highly variable return. It's easy to say, oh, the stock market's returned 23% annualized over the past 2 years. Well, statistically, the stock market has a negative or flat 0% return over the next 8 to 10 years based on where it is today. Okay? So if you invest today, statistically speaking, you will make $0 in the stock market over the next 8 to 10 years. Is that a good bet? I would say no. I would say no. So the question is, how do the rich invest? The ultra rich, they put about 20, 25% in the stock market. They have 20, 25% in fixed income. They have 20, 25% in businesses or alternatives. They have 20, 25% in income producing real estate. And why is that? It's because these asset classes go up and down in value. In 2022, both stocks and bonds lost value. That happens almost never. Okay. Real estate has lost value in the commercial space over the last 2 years. We've seen prices come down about 20% in some areas. 2007, 2008, 2009, we saw residential real estate drop in value. I predict that we're going to see that again over the next 5 years in terms of residential real estate. So if we look at all these, the question is like you have to consider where you are building your business. Is your business resilient? If you're investing in real estate, your business is in real estate, everything you're doing is involved in real estate. You know, that's like somebody that's working for a company that only buys the stock of their own company. What if you lose your job because that company is going bankrupt? Now you've lost your job, you've lost your retirement savings, you've lost everything. You know, that's a highly risky endeavor. Now on the flip side, let's say everything works out, right? You continue to, double down, double down, double down. This is what we call the Elon Musk strategy. So I don't know how many people know about Elon Musk?
Yeah.
He's not a poker player. He played poker for the first time. You know what he did? He bet everything on the first hand. Then he lost. You know what he did on the second hand? He went in, he said, double down. He doubled down until he won. Okay. Now, if you're Elon Musk and you have, $250 billion and you can afford to double down every time, that can be a winning strategy. But if you can't do that, you have to consider what's going to happen, right? And history looks back favorably upon those sorts of individuals that win in those sorts of environments. But statistically, that's highly unlikely. Warren Buffett, he wasn't really a billionaire until he was in his 50s, right? So if you're 20 years old, with today's technology, I think I'm going to live to be over 120. I'm 40, I'm going to be 47. So if you're 20 some years old, I'm 25 years older than you, you should plan to be 80, 90, 100, 120, 150 years old. Play the long game.
You got 100 years, right? if the average, that's
Yeah.
a long time
Yeah.
after 25.
Yeah.
Play the super
Absolutely.
long game. What's your resting heart rate, Chris? Is that a personal question?
Well, let me see here. The lowest it's been, it was like 36 to 38 when I was racing in college. Now if I'm in shape, it's in the 50s. I'm all fired up right now. It's in the 70s because you got me all wound up.
I like
But no, it's typically in the high 50s, maybe low 60s.
And then how do you think you're going to live to 125? I mean, I'm not doubting you, but like, what's the philosophy here? What's the game plan?
Yeah. I'm kind of obsessive about my health with respect to everything I do. But yeah, bearing a catastrophic event,
course.
car accident, something like that. No, I think we have the technology today to. There we go. I'm already 95. I like this guy. I don't know who it is, but you don't look it. No, I think again the technology we have today. For every year you live, technology today, and I think this is about right. So don't tell me it's 3.8 or it's 4.7. For every year you live today, you can extend your life. I'm sorry, what is it? Oh, I'm sorry, I got it backwards. For every 4 years you live, there's technology that can extend your life one additional year. Okay. So every year we progress, that distance gets shorter. So you live 4 years, you extend it a year. Well, it's going to be you live 3 years, you extend it a year. You live 2 years, you extend it a year. You live a year, you extend it a year. Once you're at the point where you live a year and you can extend your life a year, how old can you be?
200.
Yeah, the sky's
I
the
mean,
limit.
yeah. So right now, I said 122. That's about as old as somebody's ever lived on Earth. So I think it's a reasonable target.
Yeah, I like it. That's crazy. I think real estate's going to just kill me really early. I think I'm so stressed out. But back to the real estate talk. I'm in the
Yeah,
position right now where we're fixing and flipping. We're wholesaling. I have a mortgage company. We're diversifying, but it's all
yeah,
in real estate. And we're seeing that
yeah,
basically properties aren't moving as fast as they used to.
yeah.
And we're getting
Right.
stuck with mortgages and this and that. Yeah, we could bleed
Yeah,
out if these properties don't move, and I don't see any good
yeah,
news in the forecast. But what do you recommend for a guy like me who's in a position
yeah,
like that? We have properties that are sitting. We're paying
yeah.
mortgage payments. Do we liquidate? Do we fire sale? Do we what's the solution here? And should I diversify in other areas, right? I don't have to be in real estate, but that's just all I know. I got licensed at
Yeah.
19, 20. I've been doing it since
Yeah.
then. I'm 40 now, and all my eggs are kind of in the real estate basket,
Yeah.
such as everyone
Yeah.
else in real estate I know. So what would you recommend there?
So full disclosure, I'm like 90% in real estate too. So we're,
Nice.
we're all we're all pretty much in the same boat, most likely. Um, so I was talking about, from a general philosophy, but look, if you have a business, you probably know your business better than anything. When I've typically lost money, I've diverged from my area of expertise, which is typically real estate. So the thing is, the beautiful thing about real estate is it's like cycling. There's road cycling, there's mountain biking, there's track cycling. You can look like a football player, or you can look like a teenage male swimmer and, be successful on a bike. Real estate is very similar. There's all kinds of stuff. So I think, you have to be considerate of a few different things. The first thing is when you buy a property in today's market, I think, if you're in a speculative property, obviously that's going to be higher risk. So if you have something that's going to produce income, that's going to be your first win, right? Leverage yourself to a point where you are producing income and you can do that in a stabilized fashion. Number two, mentioning that leverage, have a reasonable amount of leverage, 50, 70%. Interest rates have been going up. It's a good time to pay down debt in a lot of ways. So you got properties, you're like, man. So we've got a property. It's a development deal. It's under contract currently. We're selling that development deal. Sell that development deal, pay down debt in other areas with variable debt or higher debt to strengthen that position and those things. And then have ample reserves. I think it's a great time to sell high performing assets, sell assets with equity, and start to build your cash reserves. Because I think we're going to see people that aren't playing by these three rules, right? Income producing properties, reasonable leverage. I said low leverage, under 70% leverage, ample reserves. They're going to be people that get blown out. They're going to say, hey, I need a partner to come in and help me float this property, or hey, I need somebody to buy me out. Just get me out of this. I can't own this anymore. You're gonna be able to come in and get a great deal on a property. And this is when fortunes are made, right? This is when great businesses are made. These are when fortunes are made. When you build your fortress for the storm that's coming up. Like that's what you want to have. So I think it's a great time to de-risk your portfolio in real estate, in the stock market. And when people get a little too exuberant, you can start to take advantage of that and put some cash on the sidelines. I think that's a great thing. We got a lot of money in our debt fund right now. We're doing private lending with 6-ish months, 6 to 9 months at the most in terms of loan duration. So we're putting money out there. We can take it back in. Leverage is 60 to 65% on that investment, for instance.
Nice. Yeah, it's good. I like that.
I think that's really good. What advice would you give? I think a lot of people on this call are in their, under 40 years old, and majority of us make 100 to 200 grand a year. And we're in
Yeah.
different markets, right? In California, that's not enough, but maybe in other
You're
markets it
scraping
is.
by out there, man.
Yeah.
That's rough. Yeah.
So what advice would you give to some of us that are, maybe a little bit younger? We have a
Yeah.
decent business, we're making decent income, and we want to get into the game a little bit further, so
Yeah.
that by the time we're 46, we're like Chris
Yeah.
over here.
Well, thank you for that. So first off, congratulations. If you're making six figures, if you're making $40,000 a year, you're in the top 1% of the world. So just take a breath, step back. You get up in the morning, say a little prayer, say thank you to whatever it is, whether it's yourself or God or the universe, because you're very blessed. Okay. So if you're making six figures, you're beyond blessed, relatively speaking, in terms of the world in general and just in history, right? We just live in an amazing, amazing time. I think we're on the cusp of some really wild things with AI and robotics and everything that we have going on. So that's number one. Come to life with a sense of gratitude and energy. Number two, look, if you're that young, learn how to invest, but your best investment at this point is investing in yourself, your education, and your business. If you can't invest in your business and generate a 10, 20, 30, 50% return, then you're in the wrong business, because a successful business should outperform an investment. So that's the big thing. Learn how to be an entrepreneur, then learn how to invest as well. Because at some point, as you scale that business, if you're growing your business, as I was saying, say 24% a year, that means you're doubling every 3 years. The rule is 72. 72 divided by 24 is 3. That means every year, if you're making 100 grand, you increase 24% a year. In 3 years, you're going to have a $200,000 business. 3 more years, 400. 3 more years, 800, 1.6, 3.2, 6.4, on and on and on. At some point, you're not going to be able to reinvest in your business to a point to grow, and you're going to say, okay, I'm going to diversify and go into other things. So focus on growing your business. Find other people that can find great deals and operate great deals and build relationships with them, so that you can build partnerships with them. So when you're ready to invest, you can put your money with them and let them run the businesses, the properties. Find somebody to run your business. Now you have a business that's running itself. You have other investments that are running themselves. And if all those things are growing, that's a very scalable model that you can grow with a lot of freedom in your own life.
Dude, I like that. That's good. All you guys taking notes? The recording will be there, so I'll post it so you guys can take some real notes later. But one thing on my notes, Chris, and I know it's kind of a touchy subject right now in the investment world, is cryptocurrency. Do you recommend any of us to have I have cryptocurrency, full disclosure. I've tried the meme coins. It's a complete scam. Like, there's something off with the whole thing.
Yeah.
A lot of these guys are in crypto, and not a lot of people talk about crypto from the investment standpoint.
Yeah.
I know Warren Buffett's maybe not in crypto. This is a new age. Do you recommend anyone get into crypto as part of their portfolio alongside the real estate and all that good stuff?
Yeah. So, Nico said your first deal was in 99. Your second deal was 2016. No, Nico, my first residential deal was 1999. My first syndication was 2016. I did probably 10 deals in between there. Yeah. Oh, there you go. DeepSeek is projecting Bitcoin at 200. So Larry Fink, BlackRock, was not for Bitcoin just a few years ago. Now BlackRock has the biggest Bitcoin ETF. So yeah, Warren Buffett, he's slow to the party. That's cool. Warren Buffett, great investor, great business owner. Do your thing. He's not the greatest innovator of all time, so I wouldn't look to him to be a futurist per se. Personally, I've been a big fan of Bitcoin for several years. I think I had an Austrian economics professor in college, and I skipped his class. I loved the class. I read all I could about it. I came in one day, he called me up. I said, I'm sorry, I missed class. He said, in his thick Austrian accent, I didn't say I have to come to class. I get called in now. I finished the semester. I hardly went to any classes. I get called into the dean's office. He goes, hey, Chris, I'm like, why am I in the dean's office? This is weird. He goes, I need to talk to you about your economics class. And I was like, oh, I was like, now I'm really in trouble, right? He goes, I need to talk to you about economics. I said, yes, sir. He goes, you got the highest grade. Congratulations. I tell you that because read about Austrian economics and the rule of sound money. This ultimately will lead you to Bitcoin and how Bitcoin was created. So I'm a fan of Bitcoin. I think it's digital gold. I I don't have a ton of my net worth in it, but I think there's a lot of benefits that come with it, and I think it's an area worth looking into. Personally, I think an easy way to look at it is like a savings account. Put some money in there over periods of time. I think the value in crypto, I agree with you, Josh, with respect to my electrician just retired off of Bitcoin. I love that. If you look at cryptocurrency in general, it's like I went through the internet boom in the late 90s. So most of those companies like pets.com didn't survive. Most of these cryptocurrencies, blockchain companies aren't going to survive. However, the technology will survive. So I think it's worth learning about. I think Bitcoin specifically, as well as the other usable cryptocurrencies that are out there, make a lot of sense. You know, look into Ethereum, look into Ripple, XRP, Tether, et cetera, things that have use. And then step back and think about what we've been talking about. We've been talking about real estate. We've been talking about cryptocurrency. So what companies are going to take crypto, the blockchain, and merge it with real estate and make it a more efficient market? Because real estate's not efficient. One of the things I love about real estate, you can negotiate. I just negotiated a deal last night. I was like, hey, you know, this is the offer. I'm like, well, I want X more. Like, we're not going to do it unless it's X more. Okay, great. Boom. Deal's done, right? You don't have that in the stock market. You're like, well, I want to buy the stock for $50. Well, it's going to cost you $60. Now there's the bid and the ask, but we're talking about really, really, really small margins, right? In real estate, it's very inefficient. So look at technologies, in my opinion, across the blockchain space that are going to introduce efficiencies. You can apply the same thing to AI, to robotics, to space, all these things. There's going to be many, many investment opportunities out there on all these frontiers that are going to create millions and billions and ultimately trillions of dollars.
Yeah, I like that. That's good. So diversify basically and kind of pick some good cryptocurrencies. We're going to open up the questions probably in like 2 minutes. I know this one thing about you. Everyone on here is on social media. I didn't see much on you on the social media aspect. Is there a reason why you're not everywhere? I mean, you're a smart guy. You got some good stuff to say. Are you just not big into social or?
Well, it depends where you looked. Okay, so where did you look, Josh?
I looked at Instagram. I looked at Facebook. Yep. I'm a little too old for Facebook now. I didn't see you on YouTube. No YouTube channel. I didn't find one at least.
We have Next Level Income Show. We've been doing a podcast for 6 years. Yeah.
Oh, really?
So I don't have it under my name.
And then the Ripple CEO popped up, and then I got
Chris Larsen. Yeah, he's a billionaire. So
yeah. I was like, is this a guy I'm interviewing? This is awesome.
Yeah.
It wasn't. Yeah. So you're on YouTube. You're on Next Level. What was it called?
Next Level Income Show. Okay. So there's my website, nextlevelincome.com. Perfect. Yeah, you can check out that podcast. So this is a great point. So I'm not a huge fan of social media, and here's why. It's a tremendous waste of time. So if you're on here and you're achieving all your goals, raise your hand. Okay? Anyone? I see no hands. So okay. So listen, I can virtually guarantee that everybody on this call is probably wasting 10 or 20, a lot of people 40 hours a week. Jeez. So how do you gain that time back? Stop looking at the news. Stop looking at social media. Stop watching sports. That's right. If it's Sunday and the playoff game is on and you're not achieving your goals in business or anything else, maybe you shouldn't be sitting around. I know it's the Lord's Day, but maybe you shouldn't be sitting around watching sports. I used to come home. I used to watch like news at night. It'd be like 9 o'clock. I'd be sitting there on the couch. Next thing I know, it's 10:30. I'm going to bed. It's 11 o'clock. I get up 6, 7 o'clock in the morning. I realized I did nothing productive after 9 o'clock at night. So logically, I said, I'm going to start going to bed, getting in bed at 9 o'clock at night, and getting up at 5. And then I was ultra productive from 5 to 5:30. So the reason I'm not on a lot of social media is because I don't find it useful. However, where do I find most of my investors? I find them on LinkedIn. So if you look at me on LinkedIn, I'm very active on LinkedIn.
Okay, cool. It's good to know.
Yeah.
Tyler, you want to open up the floor to questions? If you guys have any questions, raise your hands, and we'll get to you. Let me see the screen here if anyone is on there. Mike, any final questions before we open up the floor?
No, let's open it up, and I'll have a couple.
Nice. All right. Let's see who's got our first question. You ready for some tough questions, Chris?
I'm ready. All right. You've asked some pretty tough questions, to be fair.
Really? Nah, mine are easy. I like to have fun. I'm kind of a laid-back guy, and I want to get to know you a little bit more than like a typical interview, which I think we did. We got we got everything kind of accomplished today, so I'm happy for that. Tyler, who's our first question with? I can't see my screen.
We're waiting for whoever wants to claim the first spot. Who's got it?
I'm going to pick one. Let me see who we got in here. This guy always asks the good questions. Change my view. There we go. Gallery. Where's Richard Judge? Is he in here? Richard?
Emilio had a question
okay.
actually earlier. He kind of jumped the gun, but I appreciate that, Emilio. Emilio's question is, have you ever had a real estate coach?
Oh, good question.
Yeah. Oh, yeah. I can see here in the chat. So yes. So I sought my first mentor when I was probably 99, 2000. And he told me, Ray, oh geez, what's Ray's last name? I can't believe I'm forgetting. He wrote like the Bible on commercial real estate. And Ray said, "Hey, Chris, if you want to make a lot of money in real estate, go learn about operations, like how to manage a property." So I think that's some terrific advice. Like, you can find good deals, you can find money to make good deals, but ultimately profits come down to operations in real estate, and real estate's a business. And yeah, I still have, I've spent multiple six figures on coaching. I was just on with, my wife and I have actually a relationship coach that we work with that we were on earlier today. Nico said, I think I mentioned this earlier, your first deal was 99, second deal in 2016. I started buying residential real estate in 1999. I built a portfolio all the way up until 2005. I was able to hold that through the recession. I tried to, I'd say I timed the market perfectly. I listed my properties for sale at the end of, was it '07, I think it was. And I literally watched the market go down as my properties were on the market and took them off. So I learned some valuable lessons there. But I started investing in commercial real estate in 2013 and really never looked back at that point.
Nice. I have a question. What's your like buy box? What are you looking for in terms of properties now? Like, how do we? I mean, we get properties every single day through social media. Is there anything you're looking for specifically?
Yeah. So, and Josh, thank you. Like, you're finding deals through social media. Like, social media is an active part of your business. So I think it's important. You say like, hey, are you finding deals on like TikTok? I don't know. Maybe you are.
We have one guy who gets like 20 leads a month from TikTok. It's crazy. He's on there.
There you go. So yeah. So that's a great strategy. So if you're getting leads from that, then you need to focus on that. I've tested ads on Facebook and Instagram, and we test strategies on LinkedIn, all these different things. So you have to kind of focus on where that goes. But sorry, I just read this other question. I lost my train of thought. Can you repeat that one more time?
What's your buy box, basically? What
buy box. My apologies. Yes, so buy box. So one, I'm a fan of real estate. Two, I'm a fan of income producing real estate. So I prefer properties that are stable, that are cash flow positive. Three, I prefer properties that have some sort of way to force appreciation. So if you're in the residential market, that would be saying buying a fixer upper, right? You can say, I buy this $300,000 property, put 100 in, it's worth 500, right? You can force the appreciation by putting money in there. I like properties that have a depreciation, a tax benefit. If you're doing real estate and you're investing in real estate, right, you should not be paying taxes. You should not be paying taxes. There are so many strategies that can make things more efficient. So I look at all that, but again, going back to my book, I'm a demographics guy. I got into the medical device space because of demographics. Baby boomers are aging. What better solution than to provide them with products that are going to enable to be more active longer? I got into multifamily real estate because of the millennials renting. I think if you look at demographics and then you say, okay, what is going to give me the tailwind going forward? Things like senior housing are great right now. You can look at areas of the country. I just put out a podcast and one of my weekly updates. It may come out this weekend, but it's about like where are people moving today? Go to the U-Haul website. They'll tell you the top 5 states in the country to move. South Carolina, Florida, Texas, Tennessee, and South Carolina, North Carolina, Tennessee, Florida, Texas. Those are the 5. Be in markets where you have a tailwind, where people are moving, where customers are coming to you if you're in real estate. And then pick an asset class where people are going to need that over the next decade. Affordable housing, senior housing, great areas, industrial, data centers, all these things, right? These are great places to be in. And that's going to give you my buy box.
Nice. Yeah, I just pulled a list of every car wash in California probably like 2 weeks ago. And we're going to cold call them and see what we can get. I mean, I like the car wash business.
There you go.
The model's pretty
cash flow. Yep.
Cash flow. We have a car wash here. I think it's called Soapy Joe's, where it's like self-serve car wash, where you drive through and you vacuum yourself and all that good stuff. I don't know when society started making me do everything on my own, like self-checkout and self-car wash, but it works.
Yeah, and you're happy. You're like, this is great. Yeah.
I'll
tell you when. I'll tell you when society started doing that, when they raised the minimum wage.
Oh, okay, that makes sense. And it keeps going
Just
up,
saying.
right? It's not
minimum wage.
Yeah.
Yeah. And what's great is, minimum wage goes up. It makes technology make more sense. So they implement the technology, and that makes us do more stuff because there's self checkouts and all that.
Yeah, there's self checkouts. Now I'm ordering on an app and then picking up my food. Like I'm doing everything myself now.
That's right.
And I have no idea when that dynamic changed, but I appreciate the self-serve car wash. That business is huge, and I was like, man, I could buy one of these. Like it's not that.
Oh
hard.
Yeah, we got 32. I got one right down the road here, and
nice.
Yeah, car washes. Yeah, look, I'm a big fan of simple, durable businesses. So, you just said it. It's like I have a car, I want to keep it clean. What's the most convenient way to do that? If Tesla takes over, they're probably gonna wash their cars. So somebody's gonna have to wash Tesla's cars and do that. But yeah, something that's simple that can be an affordable luxury, for instance, right? Like bourbon can be a good investment. Car washes can be a good investment. Things that people want to treat themselves, even if the market's down, they're still going to go and spend money on that, but it's not going to break the bank. A $5 or $10 or $15 car wash or $20 or $30 membership. People are going to say, hey, this makes me feel good, right? It's like going to Chick-fil-A. It's like, okay.
Yeah. $12.99 for a car wash, unlimited car wash. I go once a week, nice and clean. Anyone with their hands up? Let me see the gallery here. Yeah. Jason?
I got a question for
Chris.
Chris.
Go ahead, Mike.
So, Chris, I know you're heavier on the commercial side of things. I guess, when did you make that pivot? Do you still believe in residential? And then the kind of another question behind that is, like, let's say I have $100,000. Should I buy a residential property that I can buy as a rental, or should I just invest that with somebody like you into a syndication? And what are the pros and cons to that?
Excellent question. So let me think how to kind of frame this out. So number one, you have to say, hey, do I have more time or more money? So if you're a surgeon, you're making $500,000 a year. Do you want to go and buy a property and put your own personal credit behind that and spend your time doing that? You're making, say, $1,000 an hour in surgery. Do you want to go and do that? I don't know. Maybe not. Maybe it's your hobby. If you're starting out, you say, hey, like I bought my first townhouse, $90,000. I rented out 2 of the 3 rooms. I mean, that was my option, right? I mean, getting in at that price point. But then there's more to that. You look at the tax code. So if I buy a house for $250,000 and I fix it up and I sell it for $500,000, and it's all sweat equity, I can sell that, and as a single individual in this country, I can waive $250,000 of tax. Okay. Where else can you can you do that? Buy a property, fix it up, rent out some of the rooms, sell it 2 years later, and walk away with $250,000 tax free. Like if you paid cash for that property, in my example, which I know is not accurate, but as an example, you doubled your money in 2 years tax free. That's amazing. At some point, the bigger the dollars, you're not going to be able to do that. So I think residential makes sense as long as you have the personal credit to buy it. Then your options that are more scalable are returning less, and the tax benefits when you factor those in make sense. Once you get to the point where you're talking about hundreds of thousands of dollars or millions of dollars, commercial real estate has an advantage in that it's valued like a business. And if you get a residential portfolio big enough, you're running it like a business. I would say that nobody that owns 100 residential properties says this is amazing. I love this business. Everybody I know that owns more than I would say 10, but I even think 5 residential properties says this pretty much sucks. I don't know anybody that owns a ton of residential properties that is like, oh, this is the greatest business in the world. It's just, got to carry a gun when I collect rent. I got, you're dealing with a whole different situation. Even at that point, if I'm dealing with that many properties, we like mobile home parks. It's a different market, but it's scalable, and we make we can increase our rents 50% and still be under $500 a month. And that's crazy, right? So, if you're in California, maybe a little different, but you have to kind of look across the spectrum. So even if you're like, hey, I'm going to get started in residential and buying $1 million property, well, what else is available out there? Maybe you can buy a dirt lot and quote unquote develop it, put in a drainage site and some paved roads, and rent it as parking for tractor trailers that are coming through across from the Buc-ee's gas station, and crush it. You can do that for a few $100,000, for instance. So just because you don't have multiple millions of dollars doesn't mean you can't invest in commercial real estate.
Got it. Good answer. Tyler says we have a whole bunch of questions. Do we have? We might go a little over. Chris, is that okay? Like 2 minutes over?
Yeah, I'll hang on a little bit longer.
Okay,
yeah.
Cool. Yeah, Tyler, go ahead. Who's up first?
Yeah, we've got this one's simple question, but how many multifamily properties have you owned?
We've acquired over 4,000 doors, so that's a few dozen.
Awesome. And then Chibsy wants to know, how would you structure a seller financing deal? I'm helping a client right now who wants to go the seller financing. I guess any insight on that?
Yeah. So you're working with a seller that wants to seller finance. Is that accurate?
I believe that's the case. Yes.
That's accurate. Yeah.
Yes.
So what they want to do that for? What reason? They want to maximize the sale price. They want to minimize their taxes. What's the rationale?
Yeah, so this particular seller, he has awful credit, right? So he doesn't want to go the conventional route, but he has a business that's making like a lot of money. He has a home care business, and he has a lot of cash, basically.
Okay. So okay. I'm not sure I fully understand the situation, but I would say, look, whoever, when it comes to business, when it comes to sales, you want to maximize the value for your client. So I think figuring out, hey, does he want to minimize his taxes, figure out what his basis is in the property, because he could take some money down up to the point where he doesn't have a big tax bill, and then you could seller finance the rest. But the point is, like, what's the interest rate? What's the market interest rate? So whoever's buying it from him should pay an above market interest rate for seller financing. And I think that you got a big lever there. We've bought properties where the seller gives us a 0% rate. Awesome. Like, I'll take that. But if you're in the seller's corner, help to maximize his return when it comes to that. Minimize his taxes, maximize his interest rate on his loan.
Nice.
And then the next question is from Diomi, who says, what is your biggest challenge in real estate as a young investor, and how did you overcome it?
Yeah, so the first one is running out of capital. So if you're 21, 22, 23 years old, as I was, trying to buy my, second, third, fourth, fifth deal, and you have no money, it's like, who's going to lend you money at that point? So you have to, in that situation, the question is like, how do you go out and find partners that you provide something complementary towards? So that's a solution to that if you're going to do that. If you're younger, you have more time, you have more energy, probably less money than other people. So utilize that. Develop a massive knowledge base. Talk to everybody you can. Take them out to lunch. Just find people that want to invest in you and are willing to, help out, mentor you, and do that. And again, the number one thing that you can do with that is go find somebody that will mentor you. And if you have to, work for free or pay them to do it, because it's way cheaper to get that advice and get that education than go learn it on your own.
Jaron, you have your hand up. What's your question?
Hey, how's it going, Chris?
Good, Jaron. How you doing?
Hey, I just got out to South Carolina. We're trying to get into apartments. I've been residential for a little bit. It has like almost no translation to commercial as we're getting into it. It's like all brand new. It comes down to the loans, comes down to like the investors, or down to the metrics you use to evaluate these deals. I'm trying to pre-market the funding so we can get into like due diligence and EMD, and to start the process and get past step 1 and 2. How would I market myself to investors to allow them to first step into me to allow free for them, you know?
Yeah. So if I'm an investor and I have any level of sophistication at all, my first question is, have you done this before? So do you have a partner that's done it before and can point to a track record?
No, I'm leading the charge on it. Yeah. So I got with me, but I'm leading the charge.
Yeah. So, I mean, again, if you can find somebody like me, it's like, hey, here's somebody who's done this. They've operated these deals. They've done these deals. You bring them on as a partner. Again, if you can go back, if anybody here is doing their first deal, any deal, okay? Has everybody here done a real estate deal? Sold a house, bought a house, anything like, okay? If I said to all of you, if you can go back to that first deal and you have to do it for free, but you will learn everything you need to know, would you do it? Yes or no?
I would, yeah.
There's your answer, Jaron. Find a partner, structure the deal so you can learn everything you know, and it's a successful deal. And even if that partner you bring on that's experienced makes all the money and you get all the education, that's a great deal for you.
For sure. Thank you so much.
Yeah, you're welcome.
All right, we got time for a couple more questions. Tyler, anything else?
Yeah, Brian asks, what are the biggest mistakes you see new investors making when structuring deals?
So over leverage and not enough reserves in the bank. And then the other thing I find investors do is they don't look at smaller deals like a larger deal or like a business. So example, you say, hey, Chris, I bought this property for $300,000 and I'm getting I put down 60%. I'm making a 30% return. I'm making $18,000 a year. And I say, okay, great. What's your who's managing the property? Oh, well, I'm managing the property, so it doesn't cost me anything. All right, strike one. Okay, what's your vacancy rate? Oh, we don't have any vacancy. It's just one house, so no vacancy. We've got a tenant in there. Okay, strike two. Okay, what are your reserves? Well, I bought it new, Chris. It doesn't need any repairs. There's no reason to have reserves because it's fully. I'm like, okay, so when you go to a bank and you say, hey, I'm renting this property out for $3,000 a month, and they say, or let's say $2,000, the math's easier in my head. They say, well, we're going to credit you $1,500 a month. Why does the bank only credit you 75% of the rent? Because it costs you 25% to run a property. In a commercial property, it costs you more than that, 35%, 40%. So if you're not assuming you're paying a property manager, if you're not putting aside vacancy and reserves for repairs, then you're not looking at that right. So that's the biggest thing that I see is that investors leverage up as much as they can to maximize the return. They don't look at it like a business, like it's scalable. So if you're going to buy one, what if you have 10? Can you do it? What if you have 100? Can you do it? How are you going to do it that way? What's it going to cost you? You have to look at it like that. Then you have to compare it to the other deals that are out there. And then the other thing I see is that investors are really bad humans in general are bad at this. This is why we're helmets. We don't assess risk appropriately. So we don't understand risk, and we don't really make decisions really logically based upon risk. So, that's the other thing. We overestimate the upside potential and underestimate the downside potential.
Good answer.
And maybe this is our last question. So Built by Bailey's asks, how do you assess cap rates from state to state?
Ooh, the sexiest question of the night. So you look at what the cap rate. I mean, there's cap rate reports all over the place. You can go and pull records from Yardi, or you can ask a broker and ask what those are. But it depends on. I mean, it depends on the local market. It depends on the asset class. It depends on, office, multifamily, industrial, Class A, Class B, Class C. What is it that you're looking out there? So everything is going to have a range based not only on geography but asset class and size of those. And yeah, local info is the best. And sorry, I was making a joke that was the sexiest answer of the night, but cap rates are super important right now because cap rates are inversely proportional to the value of a property. And Emilio asked, is that another one or is that the latest one here? Did we answer that? How do you vet, I think? How do you vet and select property managers? Is that right? So great question. Again, like when we're dealing with our apartments, we're working with large third-party managers, or I have a partner in Houston and they're vertically integrated, so they manage their own deals. And I spend time on the ground with them and want to know, how do they operate? How do they communicate? I'll sit there in the leasing office and see how they interact with potential renters coming in the door. If I want to go check out a property and the office opens at 10, I'm sitting there at 9:30. Do they show up on time? What kind of car do they drive? How do the grounds look around there? Walk around the other properties. Ask them if they know anything. Hiring a property manager is just like hiring an employee. You want to know, hey, do they take an interest in the market in general? Do they understand what you're looking for? Have they done research on your property, on you, on your business that you're doing? And do they have good referrals? Do they have a track record? Do they have a history? It's a lot of the fundamentals of hiring good people for your team.
That's awesome. Yeah, good insight, Chris. We appreciate everything you've kind of said on this podcast. I know the team has learned so much. Do we just go to your website to get in contact with you? I want everyone to get the book for sure. So at least 20 people need to go there and get the book. But what's the website again? Yeah,
Next Level Income. Let's see. I can't type and talk at the same time, apparently. nextlevelincome.com/book. You're very welcome, Ryan. Go in there, get a free copy. Reach out to me. You can email us, info@nextlevelincome.com, info@nextlevelincome.com with any questions that you have, and happy to share any advice. We do have a coaching group if you're looking more on the investment side. Click on the invest link or send us an email at coaching@nextlevelincome.com, and happy to walk through what we offer with that as well.
Cool. That's awesome. Thank you once again. Everyone, thanks for being here, asking all the good questions. We'll be back next week. Chris, thanks again. Love you, man.
Thank you, gentlemen. Yep. Best of luck to everybody. Have a great 2025. Make it the best of your lives.
Yeah, let's do it.
Thank you, Chris. Thank you, everyone. See y'all.
Later.